Like 50% off, so I don't know, like $100 each or something.
We've been warning people on the dangers of putting a lot of their nest egg into these cryptocurrencies. And I hate to say that we were right, but
No, that's good.
and not that we're right saying that it's going to stay down forever.
Not make any costly mistakes. You guys ready to go? Mm-hmm. Are you already filming? Hello, and welcome to this week's episode of What They Did Not Teach You in School with Sal Longo and yours truly. Let's get started with Bitcoin. It's been a popular thing in the news over the last year. Bitcoin, for those that don't know, is a cryptocurrency built off of the blockchain technology. It's pretty fascinating because there's no central bank or third party that has to mediate a transfer between two people. It's all done on its own through harvesters or miners, Bitcoin miners. And the cool thing is that I could transfer Sal money without anybody knowing that it came from me. Over the last 3 years, it's gone from like a couple $100s up to $20,000 in the last 3 months.
In December, yeah.
Yeah, in the last couple months, it went down to like $7,000 or $8,000, and now it's sitting around $9,000. And it's been a big craze as people have been wanting to invest in it and make money. But we consider that a speculative investment, one that real bankers are kind of split between the uses of it. I've seen like CEOs of certain banks saying that it's a scam and there should be regulations on it because it should be illegal, and I see other people saying that it's the future. What do you think? What's your thoughts on it?
It's interesting. Obviously, it could be massively used and things like that, but we've been warning people for maybe 5-6 months on the dangers of putting a lot of their nest egg into these cryptocurrencies. And I hate to say that we were right, but we were right. And not that we're right saying that it's going to stay down forever, but we're right in saying that these are very volatile, and they're not things that you should be playing with without understanding the dangers of it.
Right. A lot of people have been investing in Bitcoin, like Sal said, and we've been saying, don't put all your eggs in one basket, don't put all your eggs in one basket. Even if you are investing in a cryptocurrency, maybe it's smart to diversify across different kinds of cryptocurrencies, not just Bitcoin, but Ethereum, Ripple, in order to kind of hedge your risk.
Because that's kind of why it crashed recently, right? Because there's so many other competing cryptocurrencies against the Bitcoin. They're saying
one of the reasons, yeah.
Yeah. So we have a stat on was it Bloomberg, I believe, and it said that 88% of business leaders in the business world, like CEOs and executives, were polled, and 88% of them said that Bitcoin is a very dangerous thing. So when I hear things like that, people that are in the know, it is quite concerning. It's not really an investment. Like you're not collecting income from it, right? It could go up in value, but like you said, it's speculative, meaning that it is a gamble.
What we're going to talk about today, which is the real big takeaway for our live, is how do you build a portfolio that can withstand the ups and downs of the markets, some crazy things that could happen in the world? How do you build a portfolio that can withstand that?
How do you?
Diversification is the key.
Let's go into...
You probably have a more theoretical point of view from it, and I have more of a practical point of view from it. So I'd love to hear it from your side. How do you make a portfolio well diversified?
Okay, so classic finance is that assets or investments go up and down in value, right? So you don't want to have one asset or one egg, they say, because that egg can go up and it can crash. So what you want to do is you want to put your money in different baskets, meaning that certain assets that go up in value will crash as well. But the thing is when you have different baskets, they move in different directions. So for instance, we're going to get into it very shortly with the standard investment portfolio at an investment firm or a bank is typically bonds and stocks. The amounts vary depending on your risk tolerance. We'll get into it, but I don't want to go too much here. But what we know is sometimes when stocks go down, bonds actually go up, And when bonds can sometimes go down, not as much stocks go up. So it's not 100%. They call it inversely correlated, meaning one goes up, the other goes down, but they don't move in the same direction, which means that if you spread out your money over time, your money's not actually going crazy. It's kind of more of a smooth ride. And that makes so much sense with the fear that gets in the market. And we're going to get into market psychology later and why people lose money.
So typically a actual diversified portfolio is not just amongst individual industries, but across industries as well. I know Suds over here loves Apple, and I don't think Apple's going to be good in the next 10 years. But at the same time, I'm going to invest in Google and Apple and Facebook and Amazon across all the tech industry, as well as
some good companies.
The financial industry as well, such as TD Bank, RBC, CIBC. You won't just own RBC stock, you'll own all the bank stocks. And then not only that, across industries, it's also across countries. So you're not just going to invest in Canadian banks, you're going to invest in European banks and Asian banks and so on and so forth.
So the moral of the story is the further you diversify, the less risk and the less your portfolio or your money is going to go up and down in value.
Right.
So it's going to be a more softer ride, and you're still going to get, hopefully you're trying to get the same amount of return.
So how does somebody go and build a diversified portfolio? There's a couple options. One is using a financial advisor to build it for you. One is you could build it on your own. We're going to ignore building it on your own. We don't want to advise people to do that because not everybody knows exactly what they're doing. Couchpotato.ca is a really good place to go see model portfolios. There's two ways that you can build a portfolio. One is through mutual funds or ETFs. So those are called funds or indexes or index funds. And really what that is you give money to a portfolio manager and they diversify your portfolio for you.
Across countries, across companies, across sectors, across bonds and stocks.
Exactly. Or if you have enough money, usually an investment advisor will individually pick those stocks and buy them for you. If you have over, usually it's like $1 million or something like that, then people will invest your money for you in those stocks instead of using funds.
Just to kind of clarify or make this simple, depending on people's amount of risk they can handle, and that comes with how long you're looking to invest the money for. Is it you're looking to save for a year and you need to pull the money out, or are you looking for 40 years out into retirement? That has an impact on whether you can take a more aggressive or conservative investment.
And this is called the asset mix. So
That's right.
What Sal was talking about before is the amount of bonds. We're going more macro as we go. We started off with like individual industry, and now we're building up. So asset mix is even more macro, and it's the amount of stocks versus bonds that you have in your portfolio. So
and why? Well, stocks traditionally are more risky than bonds.
And so they provide a better return over the long term.
In finance, the more risk, the more return usually you should get. However, with stocks, the more you're going to have that in your portfolio, the more you're going to see your portfolio going up and down.
Where bonds, on the other case, is a guarantee that somebody's going to pay you back money. Usually you invest in AAA rated bonds from like the Canadian government, US government, big blue chip companies. And they say, you give us X amount of money and we'll pay you back X amount of percent monthly or quarterly or yearly.
You're giving them a loan basically when you buy a bond, yeah.
And typically bonds, if they're AAA rated, they don't go up and down like this. They just go up slowly, maybe a little bit of volatility, but not too much, right? So these are the three different kinds of portfolios that you need to know about. One is called a conservative or income portfolio. One is called a balanced or moderate portfolio, and one is called an aggressive or growth portfolio. And the only thing that separates those three portfolios is the amount of stocks and bond ratio that is inside each one. So a conservative portfolio usually has 80% bonds, 20% equities or stocks. A moderate or balanced portfolio is usually 50% and 50%, so 50% equities or stocks, 50% bonds. And a growth portfolio is usually the opposite of the conservative portfolio. So it usually has 80% bonds or 80% equities and stocks and 20% bonds. When would you use each one?
The aggressive goes up and down more. However, over time, it's gonna return a higher percent. Typically, you could see 8, 9, even 10% in these aggressive portfolios, whereas the conservative portfolio is not going to go up and down as much. It's going to kind of just go like this, but it's not going to be an 8 to 10% return. You're going to get maybe
3%
exactly,
rate of return. So if you are investing more long term, usually we say go with a growth
aggressive
portfolio. If you're investing more short term, you go with a more conservative portfolio. But speak with your financial advisor. They usually guide you through the process of picking what asset mix you want.
Which goes into market psychology. In theory, people should be getting more on the aggressive, buy more equities or more stocks, but is that always the case?
They just did a study that polled Canadian investors to see what kind of investment return they were getting on their portfolios, okay? And people that were in a balanced portfolio, they should be getting 6% per year, were getting 3% per year. And people that were in a growth portfolio that they're supposed to be getting 8% per year were getting something along the lines of 4 or 5% per year, which is ridiculous.
Does that mean there's just a bad investment, or?
The majority of the cases, it's market psychology. So let's talk a little bit about that. What happens when stocks start going up in value? The media starts to take hold of that and they go, oh, stocks have been going up, everyone's making money. Sal over here at the water cooler is going, hey Anthony, I just made 10% on my money last year, and then I think to myself, oh, I should start investing. I want to get 10% as well, right? Which now the stock price of the market is already so high, and people are, myself, I'm going in because I hear everyone else making money and I want to make money too. And that happens on the other side of the coin as well. Stock prices start going down, like just what happened recently. People are losing money. Oh, I just lost 10%. Sal at the water cooler is saying, I lost 10% on my portfolio. And I feel as if now that I need to take my money out of the stock market because I feel I don't want to lose money either.
That's right.
And that goes against what the number one rule of investing really is. Buy low, sell high.
We know that. But we see the data, and when the market's going down in value, there's a lot of money coming out of the markets. And this could be applied to the stock market. I see it in the real estate market. And market's doing really well. I see everyone going into it. Just like Bitcoin. Just like, I hate to bring up Bitcoin,
It's
but
so
it's
true,
relevant, you know? Bitcoin's going so high. I feel like everyone's calling me talking about, should I buy Bitcoin?
It's that investment FOMO, like everyone made so much money last year, they're in fear of missing out, and they want to get a part of it too.
That's right.
But the thing is that as soon as it becomes mainstream that everyone's making money, it's probably too late, and they're moved on to the next thing.
Probably.
So
So in market psychology, you typically want to have, it's not about IQ, it's about emotional intelligence, understanding that when things are going down, they'll typically go up. We're not talking about Bitcoin here, by the way. We're talking about the vast market of stocks and bonds and real estate, quality investments. They typically history will prevail.
this is where a financial advisor comes into play. If you don't know what's going on with market psychology or how to diversify your portfolio, usually a financial advisor is there as a coach. Make sure as a third party you're not making any stupid decisions, but if you are super emotionally intelligent, like Sal said, then you could potentially invest on your own.
I think really it comes down to having these discussions and reading books. Like, I think a lot of people would do so well just reading, standard personal financial planning books, like Rich Dad, not even Rich Dad, Poor Dad, more like With a Wealthy Barber, or just standard like financial planning basics for dummies or whatever. Like, those things will help you so much in terms of understanding, because I think what it is people don't want to sell when things are crashing. I think they genuinely do not know if the market will rebound, and they don't have statistics supporting every time there's a crash it's followed by a huge boom. People don't know that. I think it's hard enough understanding this and not trying to sell out of the market, because even we'll sometimes be like, well, this market's got to recover, but when you don't understand it and you don't have someone like a financial advisor or coach there with you, like hand holding you through the process, and you don't know if the market's going to recover, you almost think to yourself, the default thing is, you know what, I want to at least recover some of my money that went down in value, as opposed to investing
It's
more.
also those people that don't know, they're influenced by the media a lot.
That's right.
Where it's oh, the media just the media is going crazy, and it seems that everyone's going crazy because of the media, and then they make these stupid mistakes because they're hurting bias or whatever the case is.
Exactly.
Anyway, if you do have any questions about your portfolio or how to invest because of the volatility in the market, you know where to find us. DM us on our Instagram. We'd be glad to help. Other than that, you'll see us Wednesday mornings. This is Anthony and Sal, what they did not teach you in school. Peace.